Hey everybody, welcome. Today we're going to look at the gold price again over the last 50 years, but this time draw an exponential regression trend line over the data. Okay, so we're continuing on here with our series of analyzing various basic trend lines in statistics. Again, there are four basic trend lines. The first one is a linear trend line or linear regression. And the next three are non-linear trend lines. We already talked about logarithmic yesterday. Today we're going to talk about exponential. And we're going to do this again for both gold and Bitcoin. And then very soon we're going to talk about a power regression, which is also nonlinear, but a little bit different still. So here we are with our gold price curve. Again, we've looked at this so much. Don't think I need to go over the history of the last 50 years. You have the timeline there. You can check prior videos if you're interested. But here we have the interest rates going up to 22% during the Volcker years, kind of pricking the gold bubble in the United States, and gold being priced here in dollars and floating freely for the first time since Bretton Woods collapsed 10 years prior. Gold actually peaked at about $850 an ounce for about 2 seconds, and then in 1980, and then in December of 1980, Paul Volcker took interest rates to 22%. And then from here, we had a falling interest rate period all during this period, the Great Moderation, it was called. Some people called it the end of history at certain times. We had the Soviet Union ended, the Berlin Wall fell, all sorts of great things for freedom. But this also happened during a falling interest rate environment, which is quite different from now. And then, of course, we had the global financial crisis, and then gold popping back up in price, first in 2011, and again in recent years during COVID. So the current price as of a few days ago, December 31st, 2022, $1,812 per troy ounce. And again, remember way back in August 1971, when many economists thought that gold would go to zero, gold was depegging. The Bretton Woods agreement was falling apart. The Nixon shock, the Smithsonian agreement ended. Even though they still statutorily have a value for gold on the books in the United States, there is nothing tying the dollar to gold on the books of the United States, nor anywhere else in the world for that matter. And that all ended in the early 1970s. And then we had gold pretty much for the first time floating freely in the market in the last 50 years. So let's draw now an exponential trend line over the data. But before we do that, let's go back to our pre-examples here. Again, let's look at the formula. So this is the formula for an exponential regression analysis. Y equals A times E raised to the bx. Now, if you remember from prior videos, A and B are our coefficients. All right, A, as I'm defining it, is the y-intercept. That is when the trend line is going to pass through the y-axis at what value of y on the y-axis. And B is the slope. That is the slope of the curve. X, of course, is our independent variable. X is time in this case. And using gold, we're looking at monthly frequencies. So we've covered 617 months over this 50 plus years of data, 617 months. And that is how our data is being analyzed. That is how our X value is being plugged in to find these coefficients, A and B. The X value is time as well, and that will help us for predicting the trend line into the future. E, of course, is Euler's number. I'll explain this more in future videos when we talk about continuous compounding. The number is approximately 2.718, but it's a unique number in math, Euler's number, and we'll explain it more in the future. But that is also used in nonlinear curves a lot. It's also used in this one, which is the exponential formula. So E is Euler's number. And then Y, of course, is what we're predicting. Y is the price. That is the dependent variable. in our only one independent variable data set or two variable data set, but really you would just say a one variable data set because the one variable is time. That's the main variable, the main independent variable. And then the dependent variable thing that we're trying to derive with all of the data is price. So that is the dependent variable. It's going to depend on time and, of course, on our coefficients, which do use prior price action to determine them. And we'll talk more about that this video as well. So that's the formula. And here's how it typically looks in nature. This is on a linear scale. So again, we have our time going across on the x-axis. In this example, price going up on the y-axis. That's the dependent variable. And typically, unlike logarithmic, you remember that grew very quick and then tapered off at the end. Exponential is kind of goes in the opposite direction, but not. Basically, it grows slower, and it looks like it's growing slower on a linear axis. Towards the end, it starts to grow faster. And depending, of course, again on these coefficients, A and B, which we can find from the data that we're plotting between the x and the y variables, depending on the data, this curve will be somewhat steep or somewhat flat. But generally, this is how an exponential type curve will look in nature on a linear scale. So let's take it back to the data here, to our 50-plus year gold price history. Let's take all the price action. Let's find the A and B coefficient. Let's plug it all into the formula, and let's just draw that exponential regression line. And there it is. So this one's a little bit smoother than the example that I just showed you, but this uses the formula. It uses the same coefficients, which I just described, and you can pretty easily calculate these with a financial calculator or Microsoft Excel or Google Sheets or any statistical plotting program. You just input the y values in the past, which in our case is price, and of course you need to input the x values, which in our case is time. Now, often the way this analysis works is you need to convert the time. I don't think I've said this yet, but you need to, you see how we have dates here on the x-axis? It's not dates that are going into the statistical analysis. It's numbers. Again, remember, this is a monthly frequency, only looking at month-end prices. So every month is a new price, and it's also a new step up as far as time goes. So 1, 2, 3, 4, month 1, 2, 3, 4, so on and so forth, and we have 617 months of gold price action in this data set. Now, the R-squared, 75%. This is actually the best R-squared we've seen so far. Once again, quick explanation on what R-squared is. Let's put the all-time average in. All right, you remember this, $643 per troy ounce, in case you ever wondered that it was the all-time average over 50 years. Now, is the all-time average really useful? Maybe, maybe not. Maybe if you're a technical trader, it can be some sort of long-term support. But most people don't look at that. They look at rolling averages and all these things. But when you're doing a trendline analysis, you need to input the all-time mean to understand what R-squared actually means. Because that's showing you, it's showing you how much better R-squared or worse R-squared is over the mean. So $643, it barely touched that over the first 35 years of this data set, and then it was over the all-time mean for the rest of this data set. So then the question will be, how much better does this trend line fit the data than the all-time mean? And that's all that R-squared tells you. So a 75% R-squared will tell us that the gold price moves up or down around the trend line with 75% less variance around the trend line than around the mean. In other words, the higher the R-squared, the more the data can be explained. The interaction of the x and y axis can be explained with this trend line. Okay, so time and price can be explained much better if R-squared is very high. If R-squared was 100%, that would basically mean that it would fit the price of gold would fit exactly on this curve. It would be beautiful. Of course, nothing happens in finance and markets like that. But if it was 100%, the price would be smack dab right on that trend line. Let's take the average off. Be right on this trend line, and we would be able to predict the price of gold into the future. That would be if R-squared was 100%. Of course, it's not. But the 75%, remember, to really understand what it means, it's saying that it's 75% better or 75% less variation than the price around this flat line around the mean. So that's what it means. And the higher the R squared, of course, the better we can understand the relationship between price and time. So that's the conclusion there. And yes, the exponential regression of gold is better, and it is the best that we've seen. Now, I'm already going to give away a secret here of most trend lines that we're going to draw on this channel and most trend lines in the markets. Most of the time, markets fall on exponential trend lines. Not all the time, but most of the time, if you look at the long-term trend, even hundreds of years of stock market data, of currency data, of the way that things grow, you're actually going to find that exponential growth is a pretty common theme. Ray Kurzweil talks about this a lot. He's a big fan of exponential growth, as am I, and I'm certainly hoping that we can help educate a little bit in this realm. But it's important to see the interactions with the trend line and to actually not necessarily prove, because it's hard to say that we know what the price is going to be tomorrow. Obviously, supply and demand is that there are trends, there are ways of the world that people get used to and businesses adapt to and tend to work around. So there are trends about typical demand for gold, typical supplies of gold. But of course, only the market can decide that, and only the market price can decide that. But we can still nonetheless draw these trend lines and make some interesting observations based on these trend lines. So there we have it. That is the exponential regression trend line of the gold price over the last 50 years, 75% R squared. And again, let's go ahead and reset the zoom here and predict out what the trend line will be by 2030. Again, the slope, the y-intercept, those coefficients, as well as the Euler's number, you plug them into that formula, it's very easy to predict out what the trend line will say. So let's go ahead and take a look. We lose the all-time average, we lose the price from this date. In January 2023, we don't have the data yet. So let's just project it out, growing on the exponential trend line based on the data for the last 50 years. As we've been doing, let's go to December 2030, and there it is. Roughly $2,400 per troy ounce. $2,400 per troy ounce. And the price today is, or as of last month, $1,800 per troy ounce. Now, am I saying that the price of gold will be $2,400 per troy ounce in the year 2030? Of course not. Of course not. As we can see, over the long term, gold can be way above this trend. It can be way under this trend. And that depends on a variety of factors. If all we had to worry about were two variables, price and time, and the R squared was 99% or 99.9%, then yeah, the price would be hugging this trend line like no tomorrow, and we could pretty much conclude that that would be the price in 2030. But obviously, again, that's not how markets work. That's not how supply and demand works. And it's obviously not a prediction, not financial advice. Nonetheless, it is interesting to analyze. It's interesting to compare with the all-time average and to see how the trend line looks. Now, just two final points regarding these charts. Regarding the exponential regression trend line. You might remember from when we were looking at the physical currency supply of the United States a couple videos ago, I mentioned a very important fact that if you want to actually check yourself, understand if you're calculating an exponential regression trend line correctly, if you put it in log scale, that is this left axis, the price in log scale, and you look at the trend line, it's always going to be a straight line. Doesn't matter your base, doesn't matter how your log scale looks, doesn't matter the coefficients, doesn't matter the slope, doesn't matter the y-intercept. If you put an exponential regression in log scale, it will always form a straight line. And that also adds for help in analysis to see how our data flows around the regression trend line as opposed to how it flows around that dotted line, which is the all-time mean. We can see it certainly flows around the regression trend line much better. And then the final point I want to note is with that R squared. So again, this is 75% less variance around the trend line than around the mean, this flat line. But I do hasten to say that statisticians warn, it's warned in statistics to not overly rely on R squared for a goodness of fit for your data, particularly if you're looking at non-linear regression trend lines. And the trend lines we looked at over the last couple days, the logarithmic trend lines, the trend lines we're looking at here, exponential trend lines, and the trend lines we'll look at very soon, power trend lines. Those are non-linear trend lines. The only linear regression is linear. So when it's not a flat line, I know it's a flat line actually here during the log scale, but when it's not a straight line on linear scale, and when it's a logarithmic exponential power curve, you do want to be extra careful about overly relying on that R squared statistic. You can definitely use the eye test, see how the data looks compared to, say, the all-time mean. There are other statistical calculations you can use, such as the standard error of the regression, which is kind of like standard deviation, but it shows you how much up or down in real dollar terms the price typically moves around the trend line. And then you can compare that to other curves. You can compare that to other regression analyses. You can compare that to the standard deviation. You can compare that to the mean. But for this video, I definitely wanted to keep it simple. We don't have to use all of those formulas. We can certainly use the eye test. We can certainly look and see that the data here fits the curve much better than it fits the all-time average. And there you go. Past performance does definitely not equal future returns. Not financial advice, but this is an exponential regression over the gold price. Thanks a lot for watching.